Okay, so we had to hit record because we were yakking too much offline. So let's get into the good stuff. So give a quick introduction of who you are and what you do, because you've already told me a little bit, but I don't want to ruin it for everyone. So go ahead.
Hey, I'm Travis Jameson. Currently, my main focus is CapitalPad, a private equity co-investment group for lower middle market acquisitions. Traditionally, though, I come from a little bit of a different path than most people in the space. I don't come from private equity. I didn't get my MBA. I didn't do investment banking. I came from 0 to 1 entrepreneurship. So I've founded roughly about a dozen companies, 0 to 1, and everything from SaaS, e-commerce, marketing, health products, communities, just all over the place. I had a number of liquidity events over the years and started naturally allocating capital to different asset classes and kind of stumbled into originally it was the searcher and ETA space, and then kind of moved up to more of the lower middle market allocations. I really think it's the best asset class for a meaningful portion of the portfolio. Obviously not an entire portfolio, but that's kind of where we landed. In that spot, we realized that, or I realized, I should say, that it's very difficult for individuals to make allocations to this asset class, right? Almost all the deals go to family offices and funds writing 7-figure checks, and an individual can't really do that. So we ended up building a co-investment group around that to be able to deploy capital into these deals and to help sponsors raise those equity checks.
Nice. Yeah, it's interesting because we were talking offline about the SBA world. My first M&A deal was above that, but a lot of the content and stuff I put out is in that SBA range. And so no shade to that world. There's a lot of good deals, a lot of good people that I know in that world. But we both kind of said, well, we need to kind of get out of that a little bit bigger. And I think that I was talking to one of the partners of the firm today. One of the things about the SBA world is the liquidity events, unless you are, truly a boomer, as we'd say, and you're closer to retirement and you've stockpiled your cash and invested well, it is not really a retirement event, right? So if you're 42, you're still in the SBA range, you're probably not able to retire. The multiples are a little bit better. I say a little bit, they can be a lot better, depending on how big you're getting. It's just a different feel, and sometimes the PE appetite is different. It's just a lot different feel, I think, and I've thought for a long time, that on X, where we connected at, a lot of the content is around that kind of SBA range. But really, for the stuff that we're working on, it's bigger than that. It looks different. It shapes different. And so, what's the biggest contrast that you've seen from kind of that SBA world to the bigger, what we're calling the bigger world, for air quotes? There's obviously bigger worlds than this.
Yeah, I'm going to answer it in a roundabout way that you didn't specifically ask, but I think really tells the story. So we started initially in searcher deals, and I think just a few short years ago, 2, 3, 4 years ago, that was an amazing asset class for investors and searchers alike. And I think that's just changed so much. I think whether that's the influencers, the course sellers, or just general awareness, Buy Them Build, which is a great book, it brought a lot of awareness. I think the space has just become really, really crowded. You talk to these SMBs and they've been hit up multiple times a day from searchers and proprietary search firms, so mainly the searchers at that scale. And a lot of the juice is squeezed. And I still hear of awesome searcher deals all the time, but there's so much more noise in the space and less signal around that. So we're still open to searcher deals. We just haven't really seen a good one come to us in a long time. And that's the interesting part. You listen to Acquiring Minds or something like that. You hear these searchers that just crushed it. And recently, and I'm like, wow, it's amazing. I'd love to see that deal. But I think for every one of those you hear, there's probably 30 kind of subpar ones at this point. And the multiples aren't cheap, right? Lower middle market, you're coming in at the same multiple, but because they're not SBA eligible, they're more sophisticated. They take more experience and prowess to get these deals done. The searchers aren't competing there. So it's kind of the sweet spot. And with the searcher deals, the searchers have to wear all the hats. So you're really having to back the searcher just as much as the business.
Yeah. And curious your thoughts, because when I was working more with searchers, my advice would be, on X, there's a lot of talk about, 1 million, 2 million EBITDA, stuff like that. It's okay, cool. But those are really competitive. This was 2 years ago. So maybe look at the smaller deals. It's a little bit easier to grow them. Obviously, they're going to be more hair on them. There's problems with that. But it seems that private equity has kind of come down into that top end SBA world more, and it's made it even more competitive. And now I'm starting to see people saying, yeah, maybe those smaller deals are better. And it's not that the smaller deal all of a sudden is just magical and it's great. It's just that the levers that you can pull, if you have a sales mentality, especially, you can grow it. You can grow it theoretically. But it's gonna have more hair. The bigger deal, in my opinion, was always gonna take longer and harder, and the owner is netting a lot more money if they're doing a good job. It's gonna be harder to convince them on an SBA multiple to exit. That's what I saw. Is that what you saw as well?
Um, yeah, I mean, I don't think the math works as easily there. Also, the SBA crowd, they're putting in far less equity, which always makes me a little bit nervous. Way more debt. Um, I think in the SBA range, more of it does come down to it's the searcher is the business, right? And once you start escaping that, getting a little bit bigger, there's some sort of management team in place. Like, at the low end of the lower middle market, you're still going to have the owner wearing a lot of hats, but significantly less, right? These deals are far. I hesitate to use the word safer, but that's the first word like come to mind. They're more established. They're more processed out.
Yeah, yeah. I think that when I've done like one-on-one coaching consulting for owners, if they're in that SBA world, I'm talking to them about owner dependency because what I would see is a lot of discussion about, you know, telling owners they want too much. I'm like, man, that's a tough pill to swallow. If you fix owner dependency, to your point, the bigger companies do fix that. They almost have to fix it. And if they don't fix that, I talked to a group, oh gosh, about a month or two ago, and he was doing 30 or 40 million a year in revenue. His great connections, great at sales, but he was still sending out invoices at 9 p.m. And guess what happened? Went bankrupt because he didn't fix owner dependency because he
Mm.
was getting billed. I think he said 3.5 million on a $3 million job or whatever it was, and he was sending out invoices and he wasn't tracking all the numbers. He was great at going to get the jobs, but he never fixed the owner dependency. And in the smaller SBA stuff, owner dependency is a thing. It's like, well, if you force yourself to fix that, it just makes you fix SOPs. It makes you look at customer concentration differently. It makes you look at stuff so much differently. And as you get to these bigger deals, you do see owner dependency, but it looks a lot different than it does on a $2 million acquisition.
Yeah, I think that the skill sets that it calls out to serves different audiences. I think again, I'm a 0 to 1 type of business person, so I think probably buying a much smaller like searcher style deal would probably fit my personality pretty well. I
Mm-hmm.
know how to take that and grow it substantially in theory, right? Depends on the
Yeah.
business, obviously. Uh, but when you get in like the lower middle market, like definitely like the independent sponsor deals, I think half the time, what do I call it? I think I wrote in LinkedIn post about this recently. I think I call independent sponsors like arbitrageurs of professionalization, which really means they're if you're getting a business that's say like 1 to 5, 1 to 6 million EBITDA, then there's if you've come from the private equity world, you know how to like fix it up for private equity, right? You know how to professionalize it, how to build in like take away those founder dependencies, put in like proper systems, build in some more recurring revenue, like all these different levers that can really significantly add to the valuation of the company. That's that sweet spot. The tiny searcher deals, it's you can still do it. It's just it's harder. I think you don't have the revenue to play with that, right? To build in those systems. And once you get significantly above that, those systems are almost certainly already in place, right? And every private equity firm in the world looked at it already.
Yeah.
So I definitely think the lower end of the lower middle market is kind of the sweet spot where you can just it's kind of a playbook. You come in, you see the levers, you pull them, you
Mm-hmm.
professionalize it, and it's a much better asset. Even if you never sold it again, it would be a much better asset. But definitely
Right.
for prepping it for a bigger sell.
So private equity gets a lot of hate online. People are hating on it, and I think that has to do a few things. One, these bigger deals we'll see where private equity comes in and they'll kind of change some stuff, or a company that you view as maybe a local company, but it's actually a big national chain. And so private equity might mess it up. And then you'll hear the horror stories, but um, there's there's more private equity groups, it seems, than people would even realize. There's a bunch of them. And so there's a bunch of good deals that happen with private equity, and they're going to force you to do things because they're looking on a return on investment that should be good for your business. So, what is your take generally on the private equity market? Why do you think it gets a bad rap, you might say?
Oh, I think my opinion is going to be unpopular. Um, so to start with, I think the private equity does do bad. I have a hospital system where I live in Asheville. It's in the historically has been an amazing medical system. Private equity bought the hospital. It's deteriorated massively, right? And it's a well known thing. There's like investigations into it and whatnot. That happens, but for every one of those bad cases that you see, there's probably like 19 cases that you don't. I think overall, private equity is definitely like a net job creator, right? Again, a lot of people hear the stories of like private equity coming in and just like getting rid of all the staff and like, no, private equity, like the best returns from deals come from growth. It doesn't come from like leaning out operations. You want to lean out operations that aren't good, but growth is where like the real returns come from. So overall, like private equity, they professionalize businesses, they make them last longer. This is assuming the debt doesn't get out of control. But again, I think like the deals we look at, they don't lever them up to an unhealthy amount, in my opinion, right? So maybe it's 50% leverage instead of like a searcher deal. It's like 80, 90%. It's like 50% leverage in these businesses that have been pretty resilient for long periods of time, sometimes decades. So I don't think it's that is the big of the risk. Yeah, overall, I do think private equity has done well. They've, I think a ton of people work for them that don't even probably realize it. Yeah, a net job creator overall.
Yeah, I think there's a good chart for publicly traded companies of, you think of like Coca-Cola or, these big companies and Nestle or whatever it is. Like you ever see that chart with all the companies they actually own? It's a good way to realize, oh, wait, there's a bunch of people who are owned by someone and they don't even realize it. Like I was talking to someone today about a roofing franchise and who owns that. And you go look at it, they own a bunch of other franchises. It's like, okay, yeah. So the PE model, you might hear of the hospital example and you think, oh, that's bad. The reality is there's a lot of people who are owned by PE and never even talk about it because it's just not relevant to what
Yeah, but the positive aspects will never make headlines, right? It's always the
right.
negative. So the public perception will probably always be somewhat negative to private equity. One, slight jealousy of the insane amounts of money that the big guys print, but also more just, they see things getting worse at the hands of private equity, not realizing that most of it's good, which is fine. I mean, if I was in the space, I wouldn't know that either.
Yeah,
It's normal.
right. Yeah. That's why I always tell owners, you know more about the business you run than I ever will. Like you're a master at roofing, plumbing, tech, whatever it might be. That's your world. What I'm telling you is this is how they're going to look at it. It's a lot different. And so yeah, think about that. Kind of merge those together. Would you say is a successful trade for those who are trying to get out of the SBA world into this lower middle market world? What are some of the traits of the founders or owners you've seen?
Uh, I don't think there's just not an easy answer, right? The good sponsors that we see, they have this experience. Most of them do have actual private equity experience, because private equity, for all its, yeah, you could say whatever. These guys get in the reps, right? They do the work, they get in the reps. They are the levers that they're supposed to pull is really hammered home. They know how to put deals together. All this stuff is really hard if you don't come from that world. I don't think it's necessarily easy. I think it's possible, right? I think if someone was wanting to move up to that space, they would need to be a domain expert in some specific industry, and they would need to focus on that and then build their network over time, and then finally try and get the good deal done where you've already built that goodwill and people kind of know that you can handle it, right? The other might be to actually go work for an independent sponsor, right? Assuming someone has some skills and some like value to add, take a pay cut, go work for an independent sponsor shop for a year or two, learn how it's done, then maybe go out on your own. There are also some kind of like paid searcher programs, like what is it? NCA, what are they called? NCA Capital Advisors, Novastone Capital Advisors. Like they have a whole slew of searchers there that are, they're prepping for this. They're making it easy. The searchers are essentially, from my understanding, getting independent sponsor economics for these. So we've done one of the deals through there as well. So there are different paths. It's not easy though. It's
Yeah, no.
not quick.
I think that you mentioned kind of buy then build book, which is a good book. I agree. The influencers in the space, the searchers I've talked to kind of fall into two camps. Searchers who think it's going to be easy. All these people want to sell me their business and they understand all this verbiage and stuff. And then the ones who realize it's actually a job, like buying a business is a job. Like and it's a tough job. It's a hard job. And it's, it's wild. When I was kind of dealing with the searchers, I talked to some and they'd be like, well, no, and they start throwing all this financial jargon around. Like these owners have no clue about any of this stuff. That's not, that's not what they're worried about. They're worried about other stuff. And so you come talk down to them, it's not going to work. And on top of that, you got to talk to a bunch of them, because it's, again, to my point earlier, unless you're older or somehow they've had a lot of windfalls, this is not retirement money for them, for a lot of them in this SBA range. You get above the SBA range, it can be different. And so,
I don't know if I agree with that part though.
okay, go ahead. Why not?
I think a lot of the people with those businesses are not living overly luxurious lives, has been what I have seen in the searcher range. And if you're selling a business for $4 or $5 million, you're in your mid 60s, that's probably fine given the lifestyles that they live on average. And if they've scaled up their lifestyle over time, well, that changes that. But I've seen a reasonable amount of people that works out for. Also seen a reasonable amount of people who just kind of wait until their health forces them to do it, which sucks.
Yeah. Well, okay. If you're getting 4 to 5 million, then yes, theoretically, I'm with you. In your 60s, yes, I'm not disputing that. I've had searchers looking for $2 or $3 million. Like that's not, yeah, that's not what I'm talking about. In the
Yeah,
four
yeah.
to five million range, it seems that there's a lot of pressure now to compete with private equity groups or institutional investors or what it be for that. Um, but from the owner's perspective, how did the multiples change from in that SBA world to getting above that SBA world? What's
Easy.
the real benefit for them?
Uh, in the range that we play in, the multiples don't really change all that much, right? It's kind of crazy for as an investor investing in the lower middle market space. The multiples stay the same. The quality of the business gets way better. The quality of the revenue and of everything gets better. Now, once you start getting above that, which is what a lot of the deals that we do tries to get to, like the multiple expands a lot, right? So we're closing right now on a HVAC platform that they're going to do like a buy and build roll up. It's in Canada actually, but we're starting at like 3 million EBITDA because we've already had a couple of like add-ons for it. Great spot. It's already below the multiple of what it should be, but you get that to 5 million EBITDA and the multiples really start shooting up a lot, right? You get it 7, 8 and in the HVAC space and the multiples shoot up dramatically. But also like, $6-7 million EBITDA business, that's a big business, right? There's a lot of money coming out of that.
Oh yeah, that's what I was going to ask. So if you're hearing this, you go, okay, how long does it take me to get from 5 million to 6 million EBITDA? Like how, because it's one thing to say, oh, let's go from 5 to 6, right? 0 to 1, and that terminology, like those are numbers that in the M&A world, I think that sometimes we throw out these terms like, oh, let's do this, and we don't really think about the fact that, well, it could take some time to do this. Like I know a guy and he's got a customer concentration issue. And by the time he would actually fix it, he would just be better to never sell his business because it's going to take so long to wind that down to get the multiple to where it needs to be. He's just better off just keeping the business and just cashing out the next 3 or 4 years, whatever he needs, than trying to go to market and all that. But if you're trying to go from like 4 to 6 in the HVAC world, let's use that. Like, how long of a period normally is that?
Uh, it really depends. I mean, the easiest lever is just not going for organic growth. Buying the EBITDA essentially. Now in HVAC, that's really difficult right now because there's like 3,000 roll-ups in the HVAC in the US, and so those multiples are kind of crazy. We still see them, but I think the quality of those add-ons has really deteriorated. I think in our town, companies that aren't from a private equity platform advertise that because it's rare.
They want everyone to know, yeah.
Yeah. And also, if you're to use the HVAC analogy again, like what a competitive space to grow organically too, because again, all these funds that are well funded are throwing a lot of capital at this. So I don't know how I would do that in HVAC really. I think it depends on the owner in different situations. Frequently, I think the owner would really do much better by bringing on some sort of partner or like senior person at the company who gets a lot of skin in the game. You need like someone who's really like a hot shit person at one thing, one lever, and to let them come in and execute that. That lever could be professionalizing it. I mean, that, even if you don't grow the EBITDA, if you professionalize it and get the business like prepped for a great sell, well, that can really materially move the exit price. Or somebody who's maybe like some super ninja at just SEO and AI SEO and ads and stuff like that. I mean, that can really materially look at it. Like, most of these home service businesses, half of the business or more is really just lead gen. And we see, I mean, that's been a really nice lever. We see a lot of these businesses come in and the owners, especially if they're aging, they don't really know what they're doing with lead gen tech stuff. And they've probably tried to use some agencies, but agencies, specifically like the local space, tend to be pretty bad. Like on average, they're great ones, obviously, but like the average one's bad. And so there's usually a lot of levers to be pulled there, but it's hard to like hire that. So I think partnering with that would probably be a pretty good spot to go.
Well, you touched on something there about paying them well. I love the concept of the phantom equity. I think more owners should look at that. What are your thoughts on phantom equity?
I like it. I use it.
Yeah, yeah, yeah. I
Yeah.
think that I was I don't know, I was on X a while back, and they're talking about hiring the A talent, which I think the word A talent is a little bit overhyped, but you're trying to hire someone to get you from where you want to go, or where you at to where you want to go. The phantom equity, I think, is one of the safer ways to do that. You can pay them well, give them phantom equity, and if you structure it right, you can have them incentivized to stay on post acquisition as well because they were a key player. And so, is there any reason you think that people don't talk about the phantom equity as much?
Uh, One, not everyone at a company gets it, and so you don't want to like announce that. Um, Two, can kind of muddy things up a little bit in theory. This isn't tax advice, so I don't know how it all works, but yeah. And also, giving away a chunk of your company kind of stings a little bit. So I think the phantom equity makes sense if there are growth targets built into that, right? If the person's delivering, then they should get it and more. Um, yeah.
Yeah, I would describe it as something along the lines of, you know, base salary and normal bonuses, and then the additional bonuses they would receive are based upon the growth targets, and that's tied to the phantom equity. And then the phantom equity is paid out at closing, maybe 6 months and 12 months. You kind of get the weeds on the taxes and the legal stuff, but you set it up to where it is like, hey, this is what you're getting X dollars per year. Here's your bonus structure. I'm looking to go to here. So everything beyond that is tied to this. And so you're right, everyone won't get that kind of structure. But if you need that someone to get your business ready to sell or operations or whatever it might be, you need that one key person. It's just something that it seems to be that in the SMB world, the small business world at least, that man, they benefit by looking at that because if the person leaves, you can structure where the phantom equity goes away. Like there's no risk there. And so they're incentivized to stay to help you grow. And so but it doesn't
yeah.
get talked about. I've seen some more conversation about it recently. I don't know. Maybe you've seen a lot more, but it doesn't seem to be uh, a big talking point at least in the world that I've seen so far.
I have a non-traditional answer too, that which is very biased from my personal point of view of like where I see the world. So I don't think we talked about this, but I have actually a holdco of just companies that I've created over the years, and operators in those. One of those is a like online marketing agency, specifically like search marketing, organic marketing, stuff like that. And through that, I've really got to see the lens of all the different agencies and marketers and hires that you can make in the world. And I think for a lot of these businesses, specifically like the local, think like home services, like the traditional stuff. Again, as I mentioned, like half of the business or more really is lead gen. It's what it comes down to. And the other half is like operations. That's very, very difficult. But half of the business is lead gen. If you took away, someone's SEO rankings, their ad campaigns, and like the business would crumble within a month. The problem is, I think it's very difficult to hire for those roles. The people who tend to be very good tend to have had an entrepreneurial flair to them or doing their own thing. It's very hard to like bring them into like a W-2 type position for that. So that's why I would say to pursue some sort of separate like partner relationship with that. You can structure that however, right? So, something that we've been pursuing at our agency a little bit is find companies in like industries. We're usually like, think like B2B services, professional services type thing, business models that we know are really good. And we find the people on page 2 of Google, right? Not page 1, page 2. But look, we want to do this. I think I can double your business, but I want like 20%. You don't have to pay us anything, right? We double your business, you give us 20%. You don't pay us anything until we do. And then we actually own that equity. That's a really nice trade-off for a lot of people. I think there's stuff like that you would do really difficult. It would be hard to hire the right person for that, because I think the W-2 mindset tends to not align with that skill set.
Yeah.
Non-traditional.
No. Listen, if you're not in the M&A world and you're hearing some of this, there's a lot of perspectives on how to do a lot of things. It's just there's a lot of nuance, a lot of gray. So, uh, one thing I've told people in the past is, insert type of company here. You need to hire talent because you need to fix your SEO or whatever it is. Go find an agency or someone who's really good at, um, and offer them something to where they fix your stuff. You help them start a company. Obviously, you retain some equity in it, and then they go out and get other clients. But you're their case study, right? You're their case study. You did this, so they can go out and say to other clients, "Well, we worked with XYZ company, and now this," and then you can help fund it, and obviously you're paying for it out of your own pocket to start off, but it's helping your current business grow, and then you help them. So there's a way to do that as well. Like it's like, wait, hey, you can't. To your point about the W-2, you might not find the killer to go do this for you, but if you're an owner, you're well positioned, you might find someone who could help you grow your business and then help them grow their business as well.
I like that.
Yeah.
Win-win-win.
Yeah. And there's so many levers to pull. That's the thing. It's like there's so many levers to pull. It can become overwhelming because you're like, well, I could do this or I could do that. There's a lot of ways to skin the cat. You might find the W-2 who can do it for you, but if you can't, there's a few different ways to look at it. And so, I do think though, owners, from what I've seen, I'm curious your thoughts on this, are becoming more educated about maybe, I don't know, to the outside world, but some of these ideas that we're talking about, like, okay, there's a lot of ways to do it. And I've equated to, I'll be 41 in July. When I was growing up, my dad had a company that I ran for a while. And the thought of selling your business wasn't really real. I mean, we had some people come to us at some point and say, okay, that's interesting. But one company was trying to go public, and they were a competitor, and they were wanting to buy us up to buy the EBITDA, as you mentioned. We didn't know what EBITDA was. We said at the first meeting, like, what's your EBITDA? We're like, no idea. Um, and then we had a second company that was trying to buy us, and it was about buying some MSAs and whatnot. But anyways, um, you know, the ideas for growth back then were you go, you talk to someone, you meet them, you hope you turn them into a client. How do you find out who it is? Well, you got to go to all this stuff. And so it's evolved a lot. So the older generation has some very tried and true practices that work. But to your point earlier, they might be struggling with, oh, now there's Apollo or Zoom Info or there's webinars or there's all this other, there's local SEO, there's all this other stuff that younger people can tap into. So you might can find a way to merge those two generations going, we run a good business doing this, but we don't know how to do that. And so we need help with that. And, I see some of these results by local SEO people. And if you're good and you have a good agency or person doing it for you, you can really capture some leads pretty quickly.
Huge. Yeah. Especially if you're in the not hot markets right now. Again, HVAC, that's a tough one. You can do it, but it's tough. There's a lot of others that aren't being targeted in the same way.
Okay, so not hot markets. So someone's listening to this and they're not HVAC. They go, how do I know if my market is hot or not? And so let me give you I want to hear your thoughts. I'll give you a few ways that I've looked at this. One, the SBA data is free. You can go download it. You can see what's been bought and sold, all that kind of stuff. Two, I was talking to an SBA lender a month or two ago, and I was asking them about multiples in a certain industry, and he goes, "We haven't seen a deal in that industry. We don't know. I mean, obviously the SBA services are what they are, but the debt service coverage is what it is. But just is it high or low for that? We don't know." And so I thought, oh, that's an interesting way. So if you're trying to figure out if your industry's hot or not, there are a few ways that I've kind of learned to figure out if it's hot or not. What would you say to someone to know? Because if it is hot, then maybe you want to sell now because it is hot. But if it's not hot, how would you find that information out?
Quite honestly, I don't know how to answer that question. I have no idea. What do you think?
I mean, those are only two levers I found. Is just download the SBA data and see that HVAC. But like there was something, some companies like oh gosh, it was something to do with plants or something like that. And only like one deal had happened the past year. It's like, okay, a nursery for like plants or something, whatever it was. I can't remember now. It's like, okay, well that's not a hot industry right now, and so like you would know this is not a hot industry. But that's the only way I've been able to find it, because if you get on like social media, you can see the chatter about what people are talking about, but that's a very small snapshot. So that the data is hard to find, though. It really is. And so finding these trends of what's there, you see the big deals like, the publicly traded companies and stuff like that. You'll see what they're doing. But for this area, it seems to be hard to figure out if it's hot or not.
Yeah, I have no idea, honestly.
Okay, so we're on the same page.
Yeah, I all off the wall. I like the idea of just looking around your town and seeing the businesses that have been around for a really long time that have just been solid, and that that aren't the typical ones you might hear about, and just kind of like watching those. But that doesn't scale. I have no idea, honestly, no idea at all. But I tend to think that the acquisition entrepreneur should focus more on something that they know really well
Mm-hmm.
than trying to hop the driver's seat of something that they don't understand.
Yeah, that's true.
So yeah, you can look at the financial criteria all day long, but really like most of the returns will come from growth. And you can't grow something easily that you don't understand. Unless like maybe you're some like super marketer, you can hop into like any home services business and you can keep it running, then you can do all right. But overall, like go with what you know.
Okay, so you mentioned one of the growth strategies for companies might be, instead of organic, to buy the EBITDA. Um, so unpack what that means, and then talk about, when you say buy the EBITDA, how long after acquisition before that owner can go back to market? And then the third thing is, if they have deals under LOI, does that count for the valuation?
Uh, all right. The first thing, it's buying the EBITDA. It's the roll up strategy, buy and build. The classic playbook is you find a really good company in the industry that's probably a little bit larger on average, but it's well run. It's got some management teams. It's got good processes. It's like a solid business, and you buy that, and you'll tend to pay up a little bit more for it because it's a really solid business. And so in the Canadian HVAC deal we're talking about right now, I think the platform company were coming in at like a 6x multiple. And then you start buying the add-ons, and the add-ons will be traditionally lower in size or smaller in size, but also lower in quality. They don't have management teams in place and processes. And so you start buying those at say like 3x EBITDA, and then just integrating them into the company one by one by one. And so as you do this, you bring your blended multiple down.
Okay, okay, that's where you're going. Sorry, I was going to say, I was going to ask
Yeah.
about the multiple, but go
You
ahead.
bring your blended multiple down. So that 6x, you start combining that with 3x, 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 3x. Next thing you know, maybe at the end of it, you've paid like 3.5x for your whole platform, averaged out. But because of its size, the multiple is expanding, right? So you're no longer just 6x, it's like 7x, 8x, 9x, 10x. And so it cuts both ways, and that's where the returns get really, really good from that. So that's kind of the strategy. Different players will do different timelines with this. Sophisticated players who have been through roll-ups before, they know what they're doing. They might like this deal, we have an add-on being signed day one, so it's already settled. It's just like we have to like technically get the platform company first, and then we'll sign you immediately. And we don't even have to get more equity or anything for it. It's already there. Other companies, especially if this is your first time, you definitely want to be in the driver's seat for a bit and make sure you understand what's happening, how everything works. You don't want to start adding companies together when you barely can keep things running as is. So there's no proper timeline with that. What were your other questions?
Well, you answered one and two, and then the third one is if you have deals under LOI. So let's say you bought one or two, but you have like 3 or 4 under LOI. Would that count for that kind of new EBITDA multiple you're looking for?
Like if you're trying to sell and you have deals under LOI, it. I don't know if there's a hard rule. I actually don't fully understand or know, but I would say that say you've already combined 10 or 12 businesses there, and you've got 1 or 2 extra, and you've shown that you know how to do it, maybe those will count. If this is like your first or second one, probably not.
Probably not.
You could a lot of less trust. I thought. I don't know.
Yeah. No, yeah, like I said a minute ago, it's all kind of there's perspective because there was a company we talked to earlier this year, and uh, their client was talking about helping them buy a bunch of companies that kind of fit into their industry. And that's part of the thing is that if you're HVAC and you go buy a I don't know, a foundation repair company, that's not going to look the same. You got to
Yeah.
be kind of strategic on how you do this. And some of the thought process was, well, not only can they buy these companies that are in their niche, but also once they buy them, if they have some more under LOI, it could help their valuation as well. But it is a thing to where I always try to tell owners or buyers, it doesn't matter. There's no Zillow. Like you can't go on here and say, "Here's the house, here's the thing." And even if there was, it wouldn't work that way. It feels kind of like that, but it's just not because some owners are great at operations, some are great at sales, and so their company's going to be spent a certain way if they haven't replaced themselves enough. And so it's very much a case by case basis. And we talk about these things. We try to talk as best practices, high level. But when you get into the weeds, it's like, well, if you'd done this, it's like, well, if you'd done that, it's like, well, there's always something if you would have done to capture that growth and that value that you're looking for.
Business is messy. There's no solid playbook that you can just rinse and repeat all the time. There are
Yeah.
levers and fundamentals and that you can understand and like try and use that. But specific things, nah, business is too messy.
So let's talk about one thing that I've seen a lot of is bad financials, and they wreck deals. What's your advice for take from both sides, the owner or the buyer, on what is actually red flags and what is this? It's just how it's going to be. It's going to be messy. You got to kind of work through it.
I mean, addbacks is the biggest one, and you see sellers try to get away with a lot of stuff. They're like, oh, like this was advertising last year. It didn't work. It's an ad back. I'm like, no, that is not. And you have no idea. You don't have proper tracking. But even if you did, like, you can't add that back. You also see, how to put this, sellers might be running a lot of personal expenses through their business, which I think is probably even normal in the space. There's a degree of that though. Like once you start really pushing it, you start to question how much you would want to be like in bed with this person, right? Some of the trust might get broken a little bit. Some of it is people just don't keep good financials. I don't think I have any great rules with that.
No, it's messy because I was talking to Jackie Hirsch a while back, and she had a deal where an owner ran his boathouse, what it was, through his business, and it was like a tax write off, but it cost him. I can't remember what it cost him on the multiple, but it cost him a lot more than tax write off was. And because sometimes owners get to think about personal expenses, they can hide them, and they go to exit. It's like, well, that doesn't count now, and it's like, whoa, that costs you a lot more money than the tax write off you got. And assuming the tax write off is going to be valid even is a separate question. But yeah, so yeah, add backs. The other thing that there's a lot of contention around, it seems, is earnouts. So how do you think about earnouts? How do you try to structure them so that they're kind of above board and clean and easy? Because we're looking at a deal. We have a deal right now. It's closed, and they're kind of back and forth over the earnout because they bought a second company. They're trying to say that's part of the earnout, and no, it's not. And so, how do you try to keep the mess out of earnouts?
Yeah, well, in SBA land, I don't think you can do those for the deals that we're doing.
Yeah, this is above SBA. Sorry.
Yeah. Honestly, the sponsors when they bring it to us, they've already structured this. Um, we're looking at deals that are close to the finish line and just need an equity check. So they structure this in every single different way, and because we're not the ones structuring these deals, everyone can be different, right? The last deal we closed, it had like a fairly large earnout on it, but the owners are like in their 70s, and there was like a few shareholders that were all basically in their 70s. And we changed it where there was no earnout whatsoever, but the multiple dropped a good bit. So we like met in the middle. And that was great for us because the business is solid. So there's no right way to do it. It kind of depends on the seller, on the business, on the trust, on how much you need them, right?
Yeah.
Businesses where you really need their input, you want to keep some skin in the game for sure.
Yeah.
Also, I personally think that quite a lot of sellers just go in with that initial dollar figure in their head,
Yep.
and anything extra, like they just kind of will write that off half the time.
Mm-hmm.
So
Mm-hmm.
it only means so much.
Well, I think what you said in the middle of that is important. Is that if an owner, um, I'm sorry, on your deal that you referenced, you cut the earnout out, but the multiple went down, and so it's a thing that owners have to be prepared. And your last point I think is spot on, which is if you're going to exit, you need to know, okay, I expect to get this, and then anything above that is the cherry and whipped cream on top and all that stuff. If you don't kind of have that understanding of a good valuation or what it might be, then you might get a deal where you see these people on gurus online offer zero down and all this kind of crazy stuff. You get all these crazy earnout things, and then you'll be arguing over the earnout. So it's better off to say, okay, this is what my business should be worth. This kind of range it should be worth. I'm hoping to get a check for this. And then if there's an earnout, if I want to stay, have to stay, then the earnout should be on top of that. And it seems that at least what I've seen, our owners don't really understand that the earnout could be really risky because you've given over the reins. Could be contentious, and they didn't kind of have that mindset of, oh, I need this to go to walk away, and so they may take less than that because the earnout puts it way higher than they thought. So they might want 8. They get a $4 million offer cash with a $6 million earnout. Like, oh, I'm getting $10 million. Like, well, you might get 10 million. You might just
Yeah.
get 4.
Yeah. Yeah. I think for buyers talking to sellers, have to remember, as a buyer, you have been looking at transactions all the time. You've learned the ropes with this. As a seller, frequently this is the only time these sellers will do that, or not. They do it 2-3 times in their life.
Yeah.
They're not as familiar with it. They're not as familiar with the terms. They're not as familiar with what you see necessarily, right? And you're playing this cat and mouse game where I want to get the business, but I don't want to tell you all the things I want to do, right? So I don't want you doing them yourself. But I think taking kind of like a Warren Buffett approach of explaining things simply in plain language of why this is why the valuation is this, right? There are the different levers we can pull for the deal terms. We can move those levers, right? Depending on what you want, we'll pay the price, our terms type of thing. And then explaining if it is an earnout, explain where the earnout would come from, how this would come to fruition. I have a friend who sold a rather large business to, I don't want to name this specific bank, but a bank with a private equity arm. They're doing a roll up, and he had a large earnout that was offered. But you get to see it's based on that fund hitting a certain MOIC. And if you understand that, and then they explain this is the dynamics of what would earn us this, and it wasn't even that large. It was like a 2.5x MOIC on the whole thing. So it's that's solid. He gets a giant payday, and so you can kind of see that. And once you can understand it, then the owner can more easily accept that.
Yeah. Well, yeah. This is what I tell people: don't hire your business attorney unless you're a specialist M&A. Don't hire your cousin, the divorce attorney, because all this you gotta really have this. It's a high stakes game. It really is. It's a high stakes game, and so you got to play it the right way. It might cost you a little bit more money, but it's going to save you a lot on the back end if you don't do it right.
Yeah, I am a bootstrapper at heart, but I think a lot of these service providers around M&A are worth every penny for sure.
Yeah. Okay, so if you are an owner, start that, looking to stand out because you're thinking about exiting in the next 1 to 3 years, we'll say. A lot of interest in the space right now. I think that trend's going to continue, barring something crazy. How do they stand out? And then if you're a searcher or a buyer, how do you stand out, not only to the owner, but to someone like yourself who might come along and invest with them?
As an owner, professionalize your business as much as possible. That really is what it comes down to. Remove yourself as much as you can without hurting the business. Make sure there are number 2s and number 3s in place at the business. Don't necessarily cut crazy major expenses at the last minute to try and juice your profit numbers. They'll see through that if the business is going to deteriorate afterwards. Nothing crazy, but really just professionalize the business. Get all your financials in line. Get the proper systems in place. I don't have anything magic, nothing at all. For someone acquiring the businesses, Well, you're going to set up, your own website, right? Obviously, of whatever something holdings, and don't make it look like a generic private equity site.
Yeah,
Don't make it
yeah,
look
right.
amateur either. Talk to people like they're real people. Like that's the
Hmm.
biggest. You come in trying to look hot, show off your MBA. Like that's not going to fly very well with a lot of these businesses. Maybe a few, but overall, no. Um, they really want to, especially their family-owned businesses for a long time. Like they
Yeah,
care about that business,
yeah.
right? And so you have to learn how to dress a certain way when you go and do on sites and stuff like that. Talk to
Hmm.
them, go to certain stuff. Like, don't look fancy and flashy. I don't have any magic advice really.
Yeah, I always say that I'm redneck, talk redneck to redneck, and that has gotten me into all kinds of crazy rooms because if you talk like you're really smart, you might talk down to them, especially in this world where they might not understand all the nuance of, EBITDA and addbacks and earnouts, and they kind of heard these terms, but they don't understand how that works. And not to say that you're smarter than them. You just know something that they don't know. And so I always joke, talk redneck to redneck because you're keeping it simple. And rednecks, we're dumb. We're just dumb people. We got to ask a lot of questions because we don't know. And so it works well, at least what I've seen. So that's what I say. Okay, so if you're a searcher right now or a buyer right now, uh, or an investor maybe, what's the best way to get in touch with you and kind of how to work that process out?
Yeah. So if you're honestly, if you're a searcher and you know your thing's good, you can bring it to us. If you're a searcher and you're not sure, you're probably not a great fit for us. Independent sponsors are the best fit for us. You can just bring it to deals at capitalpad.com. You can send us an email and we'll gladly evaluate your deal and tell you if we think it's a good fit. If you're an accredited investor and are looking at like co-investing in some of these lower middle market deals, you can just sign up on our platform. You got to go through like a accredited investor onboarding questionnaire, but if you're there, then you can see that. And we aim for maybe one new deal a month, right? So we look at dozens and dozens of deals, and then we occasionally find one that we think is good enough. And kind of like there's a huge criteria of what we're looking for. What's the concentration of the revenue, like visibility, but really it comes down to, is this something that we want to put our own capital, like my own capital, personal capital into? And if it is something we like, then we'll list it. Basically what it comes down to. And then we send it out to the group and everyone can request an allocation. We spin everyone up and aggregate them into one SPV and invest in that deal. $25,000 per deal minimum for the accredited investors.
Nice. Okay. So final question for you, I guess, is a year from now we're talking, what's the state of the M&A market?
The searcher landscape's worse, right? I do think there's a meaningful chance that the SBA makes things a little bit better. They raise some caps. They've added a lot of really cumbersome rules. Like you
Mm-hmm.
can't have earnouts. The seller can't stay on, which really like messes up a lot of like license related
Mm-hmm.
things.
Yeah.
I think they did this. I was talking to actually Heather Andreessen, her, and
Oh yeah.
she's talking about, she thinks the SBA made some of these rules on like earnouts and stuff because they were thinking that the sellers were trying to get some big second payday out of it, not realizing that it's really just structuring and protection. So maybe they improve some of this and go from there. I think the proper lower middle market is just going to stay solid.
Yeah.
Yeah, I really do.
I think so as well. I think that not only for all the reasons that you mentioned, I do believe that some of these owners, family businesses, that the owner, is in his 60s or maybe 70s, he didn't think about selling ever when he started, give it to the son or daughter or whatever. Son or daughter now understands, oh, we can do this and get paid that. Like, oh, that's all we got to do. Let's go tackle that. And they're going to be really focused, which is going to push them up a little bit higher. And there's a lot of buyers right now. And so I think that you'll see that trend continue to where the top end of the SBA is going to be tough for searchers. But also we're going to see more deals creep up in that 15, 20, $25 million enterprise value range because once you realize these are the levers and you understand, okay, I don't have the talent or I do have the talent, I need to figure out, do I go acquire that? Do I go do some kind of phantom equity? Do I go start an agency with someone? Like whatever the path is, all of a sudden you get there, and then the second or third generation family member doesn't have the desire to stay on to their 70. They want to cash out, and they can cash out for a lot more than dad or grandpa could have, and because that's
Yeah.
now available to them. And so I do think that's going to be seen a lot, and we're seeing a lot of younger people building companies starting with zero, pretty fast. So it'll be interesting to see how that impacts them. So, okay, capitalpad.com. And it was so great to connect with you. I feel like there's a gazillion questions I could answer. I could ask because I always stress this, and there's so much nuance. Every deal's a little bit different. Everything's a little bit different. And so if you're trying to buy, don't get too formulaic on, let me think like this, because every company's a little bit different. Trying to sell, especially, you can't think about what your buddy sold his company for, because your company's going to have some strengths that his doesn't have, some weaknesses that his doesn't. And so you got to really work through the process. So anyways, thank you so much for your time today. I really enjoyed it.
No, the pleasure's all mine. Thank you so much.